All right, today we're going to put on our detective hats. We're going to try to crack one of the biggest puzzles in business, which is what is really going on with a company's money. We're not just looking at the headlines, we are diving deep into the raw evidence.
So here's the big mystery we're tackling. How can a company be super profitable and still go bankrupt? It sounds totally impossible, right? I mean, a company reports millions in profit, everybody celebrates, and then poof, it's gone. This isn't just some textbook example. This happens in the real world. And today, we're going to figure out exactly how. Okay, so the very first clue is getting your head around this. Profit and cash are not the same thing. They're two completely different animals. You see, high net income on one side, that's the profit everyone talks about. But then you look at the other side and you see a low cash balance, the actual spendable money in the bank. One can be flying high while the other is scraping the bottom of the barrel. So, yeah, how is that even possible?
Well, the main culprit has a name: accrual accounting. Let me break it down. Let's say you're a business and you send a client a huge invoice. Under accrual accounting, the books say, awesome, you've earned that money and it gets marked down as revenue. But here's the kicker: you don't actually have that cash, not until the client actually pays up. And that little timing gap, that can be a chasm. It changes everything.
And look, this really gets to the heart of it. It honestly doesn't matter how much profit you have on a spreadsheet. If you can't make payroll, if you can't pay your rent, if you can't pay your suppliers, you're toast. Because you have no actual cash. Cash is the oxygen. It's the lifeblood a company needs to just survive from one day to the next.
So if the income statement can mislead us, how do we get to the real story? We need a better tool for our investigation. A tool that's built for one thing and one thing only: tracking the money. And that, my friends, is the statement of cash flows.
What I love about it is how simple its purpose is. It cuts through all the noise, all the accounting jargon, all those timing issues, and it just follows the cash. That's it. It's laser-focused on answering two really basic but crucial questions. Where did the money come from, and where did the money go?
Okay, so to make this investigation manageable, the statement splits everything into three main buckets. You can think of these as the three big leads we have to follow to crack this case wide open.
First up, and honestly, this is the big one: operating activities. This is all about the cash that comes from the company's main gig, its day job. Is the business actually making cold, hard cash from selling its stuff? This is where we find the answer.
And the examples here are exactly what you'd think. We're talking about cash coming in from sales and cash going out to pay for all the essentials. Inventory, salaries, you name it. This is literally the money that keeps the lights on.
All right, our second lead takes us to investing activities. This part tracks the big money, the cash spent on huge items that are supposed to fuel long-term growth. Think property, factories, massive pieces of equipment. The analogy is perfect. It's like the company deciding to buy a bigger house so it can grow.
Yep, these are the classic moves. Buy a new building? That's cash out. Sell off some old equipment? That's cash in. And this section tells you a ton about a company's strategy. Is it actually investing to build a bigger future, or is it selling off the family silver just to survive another quarter?
And that brings us to our third and final lead: financing activities. This is all about where the money comes from when it's not from selling stuff. It's how the company gets funded. So it tracks deals with its owners, the stockholders, and its lenders, the banks. So it's pretty simple. If the company issues new stock, cash comes in. If it pays down a loan or sends a dividend check to its shareholders, cash goes out. This tells you exactly how the company's funding its operations. Is it taking on a ton of debt, or is it in a position to actually pay back its investors?
Okay, let's recap. We've got our three leads: operating, investing, and financing. We now have all the pieces of the puzzle, so let's go back to that original mystery and finally figure out what happened to that profitable company that was running out of cash.
So, how do accountants actually connect the dots between profit and cash? Well, it's actually pretty clever. They use something called the indirect method. They start with that headline profit number. Then they do a couple of adjustments. First, they add back any expenses that didn't actually involve cash, like depreciation, which is really just a way of saying an asset is getting older on paper. Then, they account for those timing differences we talked about, like money that's been earned but hasn't hit the bank account yet.
And here it is, the big reveal. Let's look at our mystery company. Okay, cash from its operations? A solid 10 million bucks. That's fantastic. But, hold on, look at the next line. Cash from investing? Minus 12 million.
Whoa, they spent $12 million on a huge new factory. Sure, they took out a small loan to help, but when you do the math, their total cash actually dropped. So the profit was real, absolutely, but all that cash and then some was poured right back into growing the business. Case closed.
So we solved the mystery. But that brings us to the verdict, the final and maybe the most critical part of all of this. Why does this one financial statement matter so much in the real world?
It's simple, because the pros know where to look. After so many big accounting scandals over the years, smart investors learned a hard lesson. Profit numbers can be massaged. They can be manipulated. But cash? Cash is a lot harder to fake. It's either in the bank or it's not. That's why, as this quote points out, the smart money follows the cash flow statement. It's where you find the real story.
And when we talk about stakes, it doesn't get any bigger than this. Remember the collapse of Lehman Brothers in 2008? It literally kicked off a global financial crisis. Now, if you just looked at their profits, things seemed okay. But if you were looking at their cash flow statement, it was screaming danger.
Check this out. This is the first giant red flag. In 2007, a full year before they went under, Lehman reported a net income of over $4 billion. Sounds great, right? But the actual cash they brought in from their core business, less than half of that, just $2 billion. That massive disconnect between reported profit and actual cash, that should have been setting off alarm bells everywhere.
But you can get even sharper. There's a metric that serious analysts love called free cash flow. It's pretty simple. You take that cash from operations we just talked about, and you subtract the money the company has to spend on essential upgrades and maintenance, to keep the business running. Whatever is left over, that's the real, honest-to-goodness spare cash the company is generating.
And this number, well, this is the smoking gun. In 2007, Lehman Brothers' free cash flow was negative $17.5 billion. Let that sink in. They weren't just not making any extra cash. They were incinerating billions and billions of dollars. The proof of the coming disaster was right there, hiding in plain sight, a whole year before it all came crashing down.
So you see, the statement of cash flows is way more than just some boring accounting document. It's a detective's report. It gives you the unvarnished truth that's hiding behind the glossy headlines. Which really just leaves one final question for you. Now that you know how to look for the clues, what story are the cash flows telling you about the companies you care about?